Welcome to Beavers Wealth Management's November 2024 edition of Let's Talk Markets. And actually, it's our last Let's Talk Markets for the year of 2024. So we've got a ton of great information that I'm excited about visiting with y'all today. As I've said before, it's our goal to continue to grow Let's Talk Markets with the intent of educating and empowering the families and businesses we serve. So, if you know of anyone who may find this information valuable, please feel free to share it with them. And I'll tell you, we have got a great show for everyone joining us today. But I'll say this, before we dive in, I wanted to share some exciting updates with everyone. I don't know if y'all have caught the first episode yet, but we are streamlining our Let's Talk Markets to bring you more information that is concise and information-packed insights into a shorter format while still delivering everything that you expect. And so I don't know if y'all have seen it, and I was just talking about it, but we wanted to remind everyone listening today that we're incredibly excited about our new podcast called Between the Bears and the Bulls, where we discuss the pursuit of excellence, business, the economy, and everything in between. Our upcoming episode is actually going to be a conversation. I don't know how they put me into this, but it's going to be a conversation of me and Ryan, and I'm going to be talking about the founding of Beavers Wealth Management. So incredibly excited to get to visit with y'all, and we cannot wait to share it with you. So please stay tuned as we will release this episode on our podcast and our YouTube and Spotify pages very, very soon. And so we look forward to doing that as we continue to operate and do more of these Let's Talk Markets and Between the Bears and the Bulls. So let's talk a little bit today. What are we going to be talking about today? Well, first of all, we're going to do a quick glance to the past. So what's happened this past month in the markets? Then we're going to do a hard look to the present. What are investors keeping an eye on this month? And then, of course, we're going to do a recap of this past month, which we're going to be talking about. And so, all right, what happened in the markets this past month? Well, we've had better than expected economic data has driven interest rates higher, changing the market narrative and contributing to an equity market pullback early in the month. And this really kind of has unraveled expectations of further rate cuts by the Federal Reserve, and actually has resulted in real rates moving higher. And so I don't know if y'all have seen this, but the 10-year Treasury has actually moved up about 0.5%. And so it ended the month at about 4.25, so 4.25%. So that's one thing. It also appeared as though that equity indexes were bound to overcome that early pullback that we saw at the beginning of October. But an end of the month slide proved to be enough to push the S&P 500, which was down about 0.5%, the Dow Jones, which was down about 1%, and the NASDAQ, which was a little in the negative territory for the entire month of October. This broadening trend we saw last quarter appears to have ended with the slightly higher rates and election uncertainty creeping into the markets. And so communication services and financials were the best performing sectors in October. Also, this is crazy to me, but the S&P 500 is on track to deliver its second consecutive year of 20+% returns, a milestone that it has not achieved since 1998, when the U.S. economy simultaneously experienced a soft landing and a tech revolution. The S&P 500 is also on pace to deliver its strongest performance leading into an election year since 1932. So it's been pretty good. 2024 has been a great year in the markets. Now I'll say this, after 5 consecutive positive months, October missed being the 6th by just a few hours when it gave back gains due to tech losses on the 31st. And really what it came down to, and the Raymond James Chief Investment Officer Larry Adam, he said overly optimistic sentiment and potential volatility surrounding the election leads us to be cautious in the near term. So we're going to get into a little bit more detail on that shortly, but first I wanted to take a look at the numbers that we've experienced year to date as it related to the markets. And so as we can see here, and we've talked a little bit about, the S&P has done incredibly well. S&P, believe it or not, the year-to-date number is over 20%. Mind-blowing. You look at the NASDAQ closing in on 30% for the year. So when you kind of take a look at that, you really start to see some of the differences between the indices, because the Dow is also had a great year, but a little closer to 17, 18% for the year. So pretty big difference between the Dow, the S&P, and the NASDAQ. What's interesting to me, the top three sectors, and we always look at this, but the top three sectors are starting to feel like the top three sectors that we saw in 2023, with information technology leading the pack, communication services right behind, and then financials, which that's a new one. Worst performing sectors, healthcare, materials, and real estate, which has kind of been the laggard all year long, but all of those double-digit positive returns. If you look at inflation, year-over-year inflation is at 3.3%. Unemployment rates ticked up to 4.1%, and GDP growth is just under 3%. So a lot of interesting data as it relates to overall markets, but it kind of gives you a sense that it's been a pretty good year in the market, as we know. Now, as we have done, and what I'm always excited to go over, is we have Ryan's market fact today. And I thought it was interesting that we focused on what's been on everybody's mind for this year is the election, right? And so it's an investor's perspective on election outcomes. And so what's our immediate reaction to the presidential election? I've had a lot of conversations with people about this, but what I thought was interesting is for us to focus on, like we did in the Between the Bears and the Bulls podcast, for anybody that had listened to it, is really what are the sectors that could be interesting under now a Trump administration. Areas like aerospace, defense, energy, financials, AI, and cryptocurrencies are anticipated to benefit from pro-business and policy support under a Trump administration. Also, it's important to remember historical resilience of markets. So despite various macroeconomic shocks, Great Depression, 2008 financial crisis, World War II, long-term market growth has shown resilience across presidential terms, regardless of party. Also, long-term fundamentals, they remain key. Investors should prioritize fundamentals such as monetary policy, inflation, GDP growth, and the Federal Reserve's actions, which shape economic health beyond any single presidency. So it's important to keep that in mind. And also data-driven insights on market stability. So the historical S&P 500 performance across presidencies underscores the importance of staying invested through political cycles, as market trends tend to weather political and economic changes over time. So I know we've talked about that before in the past, but I wanted to reiterate again now that we finally have the elections behind us. And what you'll see is this chart in the bottom right illustrates that market performance during each presidency over the past 4 years. I know it's really small and it might be kind of difficult to see, but what you'll notice is there's a ton of green, right? Despite it being a Republican or a Democrat, you typically see a significant return during that 4-year period of time. And honestly, outside of a couple of years or a couple of presidents, you had positive growth in almost every single one of those presidential parties. So now what are investors talking about this month? Talked a little bit about last month. Now, what are the key points to look at for November? So let's first look at some of the key indexes that are really starting to point to growth. That's our first thing. The ISM Manufacturing Index revealed a contraction in industrial production, which could lead to less upward pressure on the price of inputs, something that is consistent with disinflationary predictions, right? The ISM Services Index, however, showed considerable growth, showed that growth laying to rest any fears surrounding an economic slowdown. Strong employment growth, which pushed the unemployment rate back to 4.1%, reinforced our belief that the U.S. will achieve the Fed's soft landing target amid rate cuts, something that they haven't done, as we've talked about, in many, many decades. All right, another point. In support of its goals, the committee decided to lower the target rate for the federal funds rate by 25 basis points, or 0.25%, back in this month, just a few weeks ago. So now we're at about a 4.5% to 4.75% interest rate. Also, overall housing starts, they were weak in September, largely because of multifamily units, which we talked a little bit about. But single family units were strong in key regions like the Northeast. A significant risk of lowering interest rates is for home prices to increase further as lower borrowing costs attract more buyers and contribute further to the affordability crisis. So that's something that we've got to pay attention to, because it doesn't necessarily mean that because interest rates have come down, it's going to be excellent for potential buyers. Yes, it helps with lower interest rates, but also puts that upward pressure on the prices of houses. And lastly, inflation continues to trend downward, with the latest CPI report that we just got showing a 2.4% increase in prices over the past 12 months. Now, I want to show this chart below because I think the thing that I hear from clients all the time is they say, wait, you're talking about inflation numbers coming down. Why am I not feeling this, right? Why does it still feel like things are more expensive? And that's really because they are, right? This chart here compares the cumulative change in prices to the year-over-year change in prices for the last 4 years. So it really helps us visualize that despite the downward trend and year-over-year inflation, the cumulative growth still indicates that our wallets, they really haven't felt much relief. And that's why prices continue to increase. As you can see the number here from kind of when this began in January 2020, goods up 21.5%. So when you're hearing about inflation being up 2.4%, that doesn't mean that goods are only 2.4%, more expensive from when we started thinking about this just a few years ago. No, they're still more expensive. It's just the rate is slowing of that growth. All right, what else is happening, or what are you thinking about in November? Well, the S&P 500, it continues to break records. October brought about new all-time highs, and so has November, with the S&P nearing almost 6,000. So far, the Fed's activities have contributed their expected boost to economic growth, with the possibility of inflation sneaking back in as a result of cutting interest rates still on the table. So combined with potential tariffs, which I know is on everybody's mind, to reinforce the push and pull dynamic outcomes of what we will see from the economy. So the outlook on equities remains positive over the next year, but uncertainty and volatility on key macroeconomic drivers, that could create some headwinds, and that's what we're paying attention to. Now, the next chart that I'm going to be sharing here, it helps us visualize how the markets have performed this year compared to the last 34 years. And so as you'll see here, you're like, okay, what are all of these lines going, right? It's a bit of a mess, but what's neat is that blue line that you see kind of shows the trajectory and that average return from the beginning of the year to the end of the year across all of the different years that we're looking at this, from 1990 to 2024. What's interesting to me, though, is if you can see between that time, 1990 and 2024, that top line, the best performing year was 1995 out of that, worst 2008. Look at where we are, which is the green line. You really can see that we've had in 2024 that good year that we've been talking about, but where will this end? Will we get close to that 1995 number? Or do we get more back in line with what that average return will be? It's going to be interesting to see how this graph finishes for the year. Okay, now what else in November? Well, yields have gone up across the board. So Treasury yields, they took a sharp upward turn over the course of the past month, up 40 to 65 basis points from 2 years out to 30 years. So corporate and municipal bond yields have increased alongside those from the Treasury, with the most attractive part of the curve in the municipal space and longer maturities. So the muni treasury ratios, they remain mostly unchanged since last month. Okay, well, what else? Well, the oil markets, they've kind of grown numb to the Middle East geopolitics, right? Following the threat of an all-out war between Israel and Iran, both sides have eventually de-escalated. And that really has cooled off oil prices that had briefly spiked. Right? More than a year after Israel's war with Hamas began, the oil market seems to have desensitized to conflicts in that region. And so the day-to-day volatility kind of has refocused back to classic supply and demand factors. Because we're still getting mixed messages from OPEC, and it suggests the group's long period of production discipline may be coming to an end, with Saudi Arabia focusing on market share rather than propping up oil prices. And that and China's quick adoption of EVs, electric vehicles, which we've talked about in previous Let's Talk Markets, that could lead to a less than bullish sentiment surrounding oil. Also, global macros, the impact of financial markets, there's no question it's been that. And you've seen that in October. It taught us not to discount worldwide economic trends when it comes to individual financial markets. So with three major developments having had widespread influence. First development is the Bank of China has foreshadowed a loosening of monetary policy in an effort to meet the growing demands for their slowing economy. However, concerns that it may not be enough for the long term, that they've been raised. And historically, China's substantial economic growth has been attributed mainly to investment and export activity. And although short-term solutions have worked in the past, their pace may not be sustainable unless a major policy shift is implemented. That's number one. Secondly, the ongoing conflicts in the Middle East remain a source of uncertainty for commodities and equities alike. The worst-case scenario of an all-out war between Israel and Iran seems to have been averted for the time being, though the risk of escalation remains elevated as Israel continues its military action in Gaza and Lebanon. And finally, incoming economic data has led to policy response from central banks. So in Canada, for example, interest rate cuts are expected as inflation targets are reached throughout the coming months. And European data shows the consumer price index dropped to just 1.7% growth year over year in September. And with business stagnation a pressing issue, rate cuts are likely in that arena as well. What about in Japan? Political issues have weakened the yen, but seemingly helped the country's highly volatile stock market. The Bank of Japan is actually favoring steady monetary conditions until the political backdrop becomes a bit clearer. All right, that's a lot of information, and I know it was jam-packed today, but I thought it was important to kind of go through some of the data that was there, even though some of it may be a little bit more detailed than we've done in the past. But let's bring it back to the bottom line. As we move past election season, we are still cautiously monitoring uncertainty stemming from conflicts in the Middle East, as the broader economic landscape could still shift in the coming months. But certain trends remain steady, and markets are continuing to react positively to rate cuts and favorable inflation numbers. And so if you or someone you know could benefit from just a second set of eyes on their investments, know that we'd love to help. And that's why we offer our second opinion service. Ensuring that you're in a good spot with your investments is obviously our top priority. And we're here to help support you and those important to you every step of the way. Okay, so in conclusion of the last Let's Talk Markets of 2024, what is it that we covered today? Well, we talked and recapped the past month of October, examining what's been happening in the markets. And then we discussed the key market developments that investors are watching closely as they are expected to shape future market trends. So, I can't believe that the year is already coming to an end. Who would have thought? I mean, I feel like it just began, and we've done so many interesting and fun things this year, and we just want y'all to know how much we appreciate you joining us today. And We really are truly grateful for each and every one of you. So if you've enjoyed today's content, we have the replays of Let's Talk Markets posted on our new YouTube page and the video podcast format on Spotify. So please share with anyone you know who may find this valuable. Also, as I mentioned, we are incredibly excited about our upcoming episodes of our podcast Between the Bears and the Bulls. And we've got a lot of positive feedback after we released our first episode. So stay tuned as we plan to release a very special second episode of Between the Bears and the Bulls podcast very soon. I don't know about y'all. I'm hungry. I'm excited. I'm ready for Thanksgiving. This is going to be, a great Thanksgiving for everybody involved. And just know that I know personally I've been training all year for the feast that's going to happen 2 weeks from tomorrow. So enjoy the holidays and the time with family as we near the end of the year. And we will see you in January for our next installment of Let's Talk Markets. Oh, and don't forget, leave it to Beavers.